and where does it come from? Hi, my name is Gary Mishuris. I'm the Managing Partner and Chief Investment Officer of Silverring Value Partners. I also teach the Value Investing Seminar at the FW Olin Graduate School of Business. So when I started investing, which was about 20 years, or just under 20 years at Fidelity, right out of college, I used to think margin of safety was all about stock being cheap. So multiple of earnings being low, multiple of book, or whatever it might be, cash flow. And my views evolved over time. I think those are still important considerations, but there's two things you need to really have a margin of safety. I think you need a certain minimum quality of the business and of the balance sheet of the company, and then you need a price that has a deep discount to the intrinsic value. So you need both. Just having a cheap stock is not a guarantee that you're not going to lose a lot of money. There are plenty of statistically cheap stocks that go to zero because the business goes away, or the company goes bankrupt because it had too much debt, or the management team is bad and it takes your cash flow and wastes it basically. So I don't think cheap is enough. It can be a starting point, but it's not enough. And I would actually flip it on you guys and say that cheap should not even necessarily be the starting point. I would say that start by narrowing down the universe that you're looking for ideas in into things that are investable by you. By the way, that might be very different from what's investable by me. You're going to have your own circle of competence, and you want to make sure that you stay within it. So once you figured out, here's a list of companies that at the right price I would invest in their securities, and then and only then within that universe go and look for dislocations in price or statistical cheapness, or however you want to approach it. But I think that if you just start with everything in there and you go about it by looking for just statistically cheap securities, you will probably find some good ideas, but you'll also find a lot of situations where you're going to spin your wheels, do a lot of work, and you at the end will still end up passing because it's just going to fall in the too hard pile. You won't be able to figure out the future well enough in order to make an investment decision. And I guess I would leave you with this one tidbit is sometimes people think that growth, quote unquote, investing is about predicting the future and value investing is not. That's not true. I think value investing certainly puts more emphasis on what has happened and using it as a prologue for the future, and using that past history as a basis for figuring out what the future may hold. But any investment is about the future. Value comes from two sources. Number one, it's the future cash flows, or net present value of future cash flows. And number two is any excess assets that are not used to generate those cash flows. So even if you have a net, the classical Ben Graham situation where you're buying something because it's, let's say, cash in the balance sheet exceeds the current price, you still need to know the future because you need to know what the management is going to do with that cash. When will you get that cash back? That obviously determines your rate of return and so forth. So it's always about the future. Obviously, how much you need to know about the future will vary based on a number of things, the nature of the business and affiliation and so forth, but it's always about the future. Hopefully this was helpful to you. If you like this video, please hit like and subscribe to my YouTube channel for more investing videos. Thank you.